All right, let's move on to this is really significant in terms of the economy. It's something we've been tracking for a while. Let's go ahead and put the CNBC tear sheet up on the screen. So the Federal Reserve yesterday officially approved their first interest rate hike in more than 3 years. There's expectations for at least 6 more ahead this year. Now you can see, I'll keep this up for a second, you see the federal funds effective rate over there on the side, how much it has trended down. That since starts in 1980, that graph. And you can see there on the very end, that little tiny tick up from 0. That's where we are, okay? So interest rates still, by historical standards set by the Fed, extraordinarily low. But this is a major signal in terms of a change in their policy shift. And of course, this is in response to the high inflation that we've been experiencing. Now, in their statement that they put out that everybody really parses and reads a lot of, what they basically argue is, listen, guys, the economy is strong enough. We've had strong employment growth to be able to handle these interest rate hikes. So we're moving ahead. Did that reassure the markets? Seemed to yesterday.
A little bit.
Yeah, there was some recovery of losses from previously. So seemed like in the short term, not a huge catastrophe. But the balance here, the outlook is very precarious. Let's put this next piece up on the screen. This is from a CNBC Fed survey. You now have a third of the economists that they survey thinking that a recession is likely. That is up 10 points from February. A lot of things go into this. You've got one advisor saying we might be on the cusp of the Fed raising rates. At the same time, there's a minus sign in front of GDP. Of course, the war in Ukraine has increased the inflation forecast as well. So you have increased inflation forecasts. You have diminished expectations for growth. At the same time, you have the Fed raising rates. This all contributes to a really, really shaky outlook in terms of our economy. And the other piece of this that we've also talked about is, not only did the Fed lower rates back down to 0%, but they also engaged in a massive program of what is called quantitative easing, which is basically just backstopping the market. And they did this first, in extraordinary ways after the financial crash. Well, during the coronavirus crash, they amped this up an insane amount. So really extraordinary lengths were taken to completely backstop the market in, manners that they had never done before. So we also got a little bit of indication that they're going to start to roll that back and decrease their balance sheet and sell assets back. And that's the other thing that is a gigantic question mark of how quickly they unwind some of the quantitative easing that they've done.
Yeah, this is very interesting because the ripple effects throughout the economy, we just have no idea. It could spark a recession. It could change the housing market. It could change the amount of debt, which is flying all around. There's a ton of easy money if you're rich right now, even though there is obviously a consumer crunch with debt and all of that that's going on. Let's go ahead and put the next one up there on the screen, which is raising it by 25 basis points, but also saying that balance sheet reduction will be beginning at a coming meeting. That's another one, right? Because the Federal Reserve has all kinds of sketchy stuff on its balance sheet, from mortgage-backed securities and other things that they've engaged in through quantitative easing. Unloading that could itself have an impact on the market. And then when we think about where exactly things are right now, it's just so difficult. We have wages which are not keeping pace with inflation. And the Fed has a dual mandate. They have both to pursue full employment, but also to not have rapid inflation. So at one hand, we do have relatively good employment. Not terrible, but okay. On the other hand, we have 8% inflation. So this is the big problem. And also, the inflation that we have is not really a result of monetary policy. Most of it is through a massive demand hike given the end of COVID and these huge supply crunches all across the economy that are a result of globalization, oil markets, Saudis, which we just talked about, all kinds of crazy stuff. And you put that together, and it's a very difficult situation. I've seen some predictions that stagflation could again happen because of this crazy kind of roiling within the markets, both on the monetary side, but also on the supply side. And let's go put this up, next one up there. Really what it is about the level of uncertainty in the financial system, which is that most Fed officials here see as many as 7 rate increases in 2022, Krystal. So we could have an interest rate, who knows what the interest rate could be at the end of this year. That would massively impact housing prices, like all kinds of stuff.
And some people are even saying that it's possible they raise rates even more quickly because the war has added to inflation expectations. And then, you covered how China is now in a new lockdown. Now, on the one hand, their decreased demand for gas could help to lower gas prices, but obviously that's going to create massive supply chain issues once again. So very, very uncertain landscape here. And there is one way. So when we think about like food prices and gas prices, those are the things that we normally think about when it comes to inflation. But there is one way in which the Fed really did contribute to inflation, which is at the high end of asset prices. Because they effectively, this was a massive multi-trillion-dollar, as David Dayen says, cannon shot at the markets, right? The wealthiest among us. They backstopped not only the stock market, but also the bond market. So this is why you had these dueling headlines at the worst of the coronavirus crash, where it's like massive job loss, massive numbers of unemployment claims, and the markets hitting new record highs. The Fed's policy is why that was happening, and that was much more about their policy of quantitative easing and the really unprecedented lengths that they went to there and the type of things that they were buying and backstopping. That's what was creating those dynamics. So you have some economists who say, we had a housing bubble in the financial that caused the financial crash that we're all familiar with. Now we kind of have an everything bubble in terms of asset classes. And the Fed has to be very careful how they execute this policy because, you do have to deal with inflation, and that's very significant. But you can have these cascading effects where the bubbles pop and then there's just a complete collapse. And while you may not have benefited much on the way up, if you're an ordinary person who's just struggling to make ends meet, you will certainly be hurt on the way down if these bubbles ultimately pop.
Found all that out in 2008 the hard way. That's why we cover it, so in depth. It's because we know, if a company can't borrow in order to make payroll, you're fired. If they can't finance a new expansion or they have to pay more on their debt, you're fired. If the
value of your house collapses.
The value of your house collapses through which you have a loan, you're done. You're going to get evicted. You're going to get foreclosed. These are real consequences that we have already seen. And, the whole too big to fail thing, obviously that didn't work out so well. Almost a decade more than a decade after the financial crisis. And now it's been 14 years. We're really due for some sort of crash. There's all sorts of wonky stuff that's happening within the economy. Everything is super expensive, but also we have a decent labor market if you're working class. There's a disconnect there. Wealth, obviously, is flying around at a historic rate. So everything just feels completely crazy, and you just never know when the music stops. And when it does, it's not the rich people who suffer. It's you.
Yes, that is exactly right.
Hey guys, we're going to be totally upfront with you. This is the most perilous time that we have ever operated in.
It is so difficult just to try to sort through the news, but even more importantly, to bring you accurate information as this wave of lockdown and censorship spreads across the nation.
Yeah, look, if you can become a premium subscriber today at breakingpoints.com, you're going to help us build out a vibrant, independent media ecosystem, which is free of mainstream pressure. We can't tell you how important that is at a time like this.
Yep, that's right. Go to breakingpoints.com to subscribe. We love you guys, and we appreciate you so much.